Hi everybody, it's AJ speaking. In this presentation, we will be focusing on Tesla's fourth quarter 2025 results. So this video is not an outlook and we will not discuss Tesla's forward-looking statements. I will cover those in a separate video. You see in front of you Tesla's current share price. It's currently the pre-market after Tesla's earnings call, and the stock currently trades at $441 or just under $442 per share. And now you look at Tesla's share price exactly 3 months ago, right after the Q3 earnings call in pre-market, and the stock traded at $447 per share. So the stock is down $5, or broadly speaking flat. It's just roughly 1% delta. I think that's an important observation because effectively the stock just traded sideways for an entire quarter. And even though there was significant progress in FSD, robotaxi network, there are a lot more cars now. And most importantly, we got yesterday management's forward-looking statements and some guidance, and the stock is still effectively flat. But as I said in the beginning, this video is about the historical performance and all these other items, tactical and strategic items for shareholders, I will discuss in my deep dive outlook. With that out of the way, let's get right in. As usual, we start with revenue, but for people who watch my videos for the first time, let me just briefly explain how these slides work. Here in the main part of the chart, you have the quarterly numbers, of course, here shown in dollar billion. The first row of percentages is always the quarter-over-quarter change, and then in the second row, underscored, is the year-over-year change. Here on the right-hand side, you have spelled out the key numerical changes for the quarter, for the full year, and for the trailing 12 months. Please note, because we are now in the fourth quarter, the full year and the trailing 12 months, they overlap. So the only delta between the two is that the full year compares the full year with the prior full year on a year-over-year basis, and the trailing 12 months compares the current trailing 12 months with the last quarter trailing 12 months to look at how the annual revenue growth changed on a quarter-over-quarter basis, while the full year looks on a year-over-year basis. Why do people do it that way? Simple, it's to get different ways to assess the trend. And then here on the far right hand side is what I like to call the navigator. The navigator shows you the key, the most relevant financial statement, and then in the red box highlights the most applicable line item in that statement. And this can vary quite a bit. For example, when we look at in the energy and in energy storage and in the energy generation storage segment, when we look at storage deployed in kilowatts, of course there is no kilowatts line item. We'll be looking at the revenue item in that segment. For financial professionals, this of course is a bit unnecessary, but keep in mind I speak to a very broad audience. A lot of people do not have burned into their retina the structure of income statement, cash flow statement, etc. So with that out of the way, now let's finally look at the numbers. So first of all, let's start with the quarter. Total revenue came in at just under 25 billion, 24.9 billion. It's a year-over-year decrease of 3.1%, or quarter-over-quarter decrease of 11%. So what was the main driver? The main driver is that auto sales significantly reduced, and the primary driver of that was basically two things. Number one, Q3 was inflated by people rushing in the US to get to take advantage of the tax credit before it would end. This naturally pulled demand from the fourth quarter into the third quarter. And then, of course, there was not only the Q4 demand that moved into Q3, but also, of course, a naturally lower level of EV demand as the price of EVs effectively increased for a lot of consumers by $7,500. Outside the United States and Europe, Tesla's sales actually were quite decent or quite strong, especially in some smaller countries. Sales were exceptionally strong. China sales were also good, not exceptional, but quite strong overall, I would say, given the exceptionally significant competition in China. And this mix shift created some very interesting financial results, or effects, I should say, which we'll be discussing in detail in a little bit. But before we move on from total revenue, let's just zoom out for a moment. So this chart shows you trailing 12 months revenue for the last 11 years. That's the blue colored line or teal color. And then in this bright green color, you have the year-over-year revenue growth so how the trailing 12 months grew year over year. And in red, you always see when the year over year trailing 12 months revenue declined. And you can see if the key observation here that Tesla's trailing 12 months revenue is effectively flat for the last 2.5 years since the second quarter of 2023. And then when you look at the revenue growth rate, you can see it very clearly. In the early years, back in 2016, 17, 18, also partially 2019, Tesla with super high growth rates. And then as the COVID lockdowns eased a little bit, and there was a shortage in the auto market, combined with attractive incentives, etc., there was a massive increase in revenue again. And then there was more and more competition, and a lot of other things happened, and then revenue growth slowed significantly, grinded effectively to a halt, and that's why for the last 2.5 years the top line effectively was flat. So despite this somewhat lackluster revenue development, the company trades currently near or not too far off from all-time highs, and the stock trades on a forward multiple basis near all-time highs. So why is that? The answer might lie in the next slide. So this slide shows you the development of how many miles are driven daily on FSD globally. And you can see that number is increasing quite a bit. It's now at 17 million miles per day. And you can see that in 2023, we don't have the data for 2022, but in 2023, there was a little bit lackluster. There was quite a spike here in the second quarter of 2023, but then it was mostly sideways. Then there was a substantial increase, had to do with certain one-off effects, and then also a little lackluster development. Then yet again a little flattish development, and then since the third quarter of 2025, there was a quite significant increase in the miles driven on FSD. And in my view, this is basically the ultimate measure of FSD's quality. If the software is really good, no matter whom you follow, what video you watch, what commentary you read, ultimately the proof is in the pudding, and the more people use it, the better it must be. Very simple. If you wonder where's this data from, this is directly derived from Tesla's disclosure. So there are no assumptions whatsoever. Then in this context, let's look at a new metric. So this is a metric Tesla has never before shared, to my knowledge, or at least not directly numerically. They did make comments in the past from which you could infer it, as I have done. For example, last quarter I calculated Tesla would have 1 million FSD users, and yesterday, for the first time ever, Tesla disclosed the actual number, and you can see it in this chart. Tesla did report 1 million users for end of September, and the latest number is, as of December, rounds to 1.1 million users. We don't have the decimal, we don't know exactly, so there's a little bit of error margin here. But the one decimal and the million number Tesla gives us, we can see there is probably some meaningful growth. I'd like to point out Tesla causes active FSD subscriptions. That can be slightly misleading. Tesla added a footnote, and in that footnote you can see that this also includes all the purchased FSD. So it's basically everyone who in some shape or form paid for FSD either fully upfront or via subscription, but it does not include trials. And that's why I coined it the number of monetized FSD users. From an analytical perspective, this is a little bit unfortunate because it doesn't show us directly the new money coming in, or sorry, we cannot directly use this number to infer the FSD revenue, because, as I said, it already includes the upfront paid FSD. But because Tesla defers the revenue and releases that revenue over time for FSD that was paid upfront, the metric is not ideal, but because of this deferral mechanism, it is quite useful to directly calculate ongoing FSD revenue in a that is recognized, but it does not ideally correlate with cash received. It's just an important distinction, but this is mostly stuff analysts care about and most investors probably won't. So the key takeaway here is, and it basically confirms the prior chart, that there was a period of little excitement, stagnation, but then from the second quarter of 2025, there was a meaningful increase, and it kept going. And the golden question really is, will this accelerate or will it kind of take up in the same fashion as it's shown right here? I think time will tell. I think a lot of people are betting right now there will be rapid adoption the moment FSD becomes a true chauffeur feature. People can sleep in the car while the vehicle is in motion, etc. I think once that happens, the value increases basically by 10x. But I would caution people, because people are so used to driving, etc. It probably takes some getting used to, and this may actually, at least in the beginning, slow somewhat the adoption. I think the adoption would be very rapid if nobody knew to drive, and there was a choice between getting a driving license and learning how to drive, or going straight to robotaxi. I think if we were in this scenario, which is of course not realistic, there would be incredibly fast adoption. And I think people, when they talk about this stuff, they forget that people are set in their ways often, and to get them out of their habits, etc. And also for stuff they already paid for. People paid for the driving license, and it can be very expensive depending on where you live and the vehicle. So now get them to move to something else takes a little bit of convincing. That's why I would recommend not to be too optimistic about how quickly this is being adopted. But it's good to see the needle is going in the right direction. Last point to mention is that Tesla did point out in the call that right now they're not disclosing the revenue they generate with FSD because it's not material, to say, with robotaxis. And now let's move on to what is still the meat of the business, and this is the automotive business. So you can see that part of the business which comprises automotive sales and automotive leasing. However, automotive leasing, something we're not going to discuss to save a little bit of time because it's not a needle mover. So it's mostly about automotive sales, and that part of the business decreased 10% year over year and 17% quarter over quarter. Again, this is due to these one-off effects caused by the end of the tax credit in the United States. Of course, one of the key markets for Tesla. So total automotive revenue came down to 17.2 billion. And you can see the fourth quarter is in the automotive industry typically a strong quarter, and you can see that's the weakest fourth quarter in basically at least the 4 years that's shown in this chart, so over a long time. And you can see down here the total for 2025 reduced to just under 68 billion, and it's sort of the full year is down 9%. After last year was down 8%, and you can see in 2023 the auto business effectively peaked. Here you can see the key driver of the auto business is obviously vehicle sales, and in the fourth quarter vehicle sales, but it's an old number. We know this number since January 2nd, but it's just to remind everyone, reduced to 418,000 vehicles. That's down 16% year over year and 16% quarter over quarter. And you can see the third quarter of 2025 was an outlier, but barely a new all-time high, and that was caused by primarily by the one-off effects I mentioned before. And you can see down here that total vehicle sales came down by 9% to 1.636 million vehicles, and that's after last year's 1.789 million. That was also down, but down less, 1%. And you can also see that the largest number of vehicles Tesla sold was in 2023, and just over 1.8 million vehicles. At this point, I'd like to just pause for a second. It's always good to kind of take the data in, and then also kind of the lessons learned. If you've followed Tesla for a long time, you will know that in this period, 2022, we looked at basically all the forecasters. They had like 2.2 million in 2023, 2.5 or 8 million in 2024, 3 or even 3.5 million vehicles by 2025. So you can see reality turned out quite different. This is always something to keep in mind. This was also a period where basically a lot of people were quite dismissive about competition, very dismissive about Chinese competition or other automaker competition. I think one should just, if you were in that camp, and I admit I was partially in that camp, I knew that at some point competition would catch up, and competition has caught up, not in FSD, but there are vehicles on the market that not to the fan, but to the average consumer, provide a vehicle that is as good, or arguably some consumers argue, oh, I like that car better. and the data is irrefutable at this point. And whether you rationalize it with vehicle quality or branding or political things doesn't really matter. Next, let's look at the other key metric. So that there's not only vehicle volume, but the almost, or maybe perhaps equivalently important metric is average selling prices. And here's a bit of good news. On a year-over-year basis, average selling prices increased by 6%. Tesla's global average selling price, and this is effective average selling price. I will not get into what exactly the difference is, but this is the best metric to compare the trend, and is a $40,100 in the fourth quarter. However, I have to point out that that average selling price was likely boosted by larger scale shipments of the Model Y Performance, which was largely not available in the third quarter, and most deliveries, as far as I know globally, took place in the fourth quarter. So this will have lifted the average selling price somewhat. And I think this is the primary source. There are some other items, and all combined drove the beat. Tesla beat earnings estimates. Tesla reported 50 cents adjusted earnings, while consensus, depending what consensus you looked at, was either 44 cents or 45 cents. But the higher share of Model Y Performance was one of the drivers, but there are others which we'll get to in a moment. Next, we look at regulatory credits. So regulatory credits is effectively pure profit to Tesla. So it's in a revenue line or a category, but there's essentially no cost against it. So this is a very important. And the way you can conceptualize it, think of it like a business line with a 20% gross margin. If you have 500 million in regulatory credits, it's basically worth 500 million divided by 20%, and that would be 2.5 billion in revenue. So what can we see here in this trend? Of course, after Trump's January 20 speech, where he announced that he would slash all these emission standards, etc., then of course people were reluctant to secure emissions credits, and then of course Tesla's regulatory credit sales quickly reduced. And a lot of people, including myself, were surprised by the spike in the fourth quarter. But in retrospect, one should have been able to see it coming. And the reason was a paradoxically significantly improved mix, because US sales were relatively small in the fourth quarter for the one-time effects we already discussed. Sales from other parts in the world, and many of these parts have still emissions credits. Tesla did earn a higher share or a higher number of emissions credits in these non-US markets, and that helped Tesla to increase credit sales yet again. And this was part of why Tesla beat. So this is the second driver. So number one, high Model Y Performance mix is a high margin product, and then higher credit sales. Next, we look at the energy generation and storage segment. This segment grew nicely, up 25% year over year, 12% sequentially. And that segment is up for the full year 27% to $12.8 billion. I think a lot of people, if you had asked them by how much this business would grow in 2025, they probably would have given you a higher growth number than 27%, because Tesla's deployments guidance was, I quote, at least 50% year-over-year growth rate. The reason why the revenue came in much lower in terms of growth rate was that there's significant competition in that market and battery storage, and so that's one reason Tesla is. And they also talked about this openly, I think, for the first time on last call, really, or yesterday, that this will basically affect average pricing. Some people basically offer battery storage at almost half the price, not in North America, but in Asian markets. So there's enormous price pressure there. The North American market is more protected, or specifically United States. And this creates a situation where if there is more Asian volume, there's more average selling price dilution, because these products sell a lot cheaper than the ones sold in the United States. And then so you have these two effects. One, competition reduces average pricing, and number two, there's a dilutive effect from more lower cost sales in non-US markets. And the net effect is what you see here. You have, in quotes, only 27% revenue growth, while deployments grew by 47%. 49%. 47 is the number of gigawatts deployed for the full year in 2025. So this is what you see now in this chart. And the fourth quarter of 2025 was widely expected, was a new all-time high. Deployments grew 29% year-over-year, 14% quarter-over-quarter. Next, let's look at the pricing that I just mentioned. So this chart shows you revenue per kilowatt deployed in dollar, of course. And you can see that the fourth quarter of 2025 decreased sequentially by 1%, is down 3% year-over-year to just over $270. And I think the drivers are that Tesla benefits from strong pricing thanks to hyperscalers, thanks to also home battery storage, this is high margin business, while there's a dilutive effect from the growing battery storage sales in Asia. And then when you look at the volume weighted average price, pricing is down 15% in 2025. And you can see there's a massive price decline. 2024 was down almost 22%. 2023 was down 31%. I expect that pricing likely comes down by at least 10% next year. Or I should say this year, 2026, on a volume weighted basis. Next, we look at the final large segment disclosed by Tesla, and it's the services and other segment. This is where Tesla books all the paid vehicle maintenance or repair. Also, used vehicle sales is a large driver. All the paid supercharging sessions, Tesla insurance, merchandise, so everything else not already discussed. I'd like to point out that all FSD revenue paid up front or subscription is booked in automotive sales. So when you look over here, automotive sales is part, of course, of auto revenue. So now let's look at service and other. So this is Tesla's most consistently growing revenue line. And you can see here on the year-over-year, this is consistently growing in high double-digit numbers. It's even, with few exceptions, almost always growing quarter-over-quarter. And the answer is simple. This business is significantly driven by Tesla's growing vehicle fleet, growing supercharger revenue. So as the company overall grows, there's a lot of small incremental revenue Tesla can pick up. The only problem with that business is it's not very high margin. So now we are at the end of the kind of the revenue review. So now let's summarize everything. And for that, we look at this chart. So this chart shows you the revenue bridge from the Q4 2024 to Q4 2025. So Q4 2024 was 25.7 billion. Q4 2025 was 24.9 billion. So what changed? Automotive revenue came down by almost 2 billion. Regulatory credit sales came down by 150 million. Energy generation and storage provided a nice offset of almost 800 million. And also the just discussed service and other segment grew nicely, also provided quite material offset with over 520 million. So Tesla's non-auto segments helped materially to offset the revenue decline. By the way, the reason why we look at year-over-year metrics is there's always a lot of seasonality in businesses, and that's why it makes sense to look at them on a year-over-year basis. But in this case, because we had this large US tax credit related one-off effect, the year-over-year comparison is really quite limited. Because of this seasonality, I do believe that there are two ways to look at it. One, the Q4 2025 is, you could call it, artificially depressed by drawing Q4 demand into Q3. Or you can look at it the other way. The Q4 2024 revenue was inflated by tax credits. I think because you want to be forward-looking, ideally what analytically what one should do is, if you really want to see what's going on, you look at, okay, what would be the 2024 Q4 revenue excluding tax credits? Of course, it's a very difficult exercise, but I think it gives you an idea that revenue overall was not really shrinking on an underlying basis if you adjust for this one-off effect. But having said that, I've been long enough in the market that I can tell you investors don't really care about that stuff. They certainly do adjust for one-off items, but they typically do this as the quarter is reported, and then they are forward-looking. So next we look at the revenue bridge on a quarter-over-quarter basis. And here you can see very clearly this massive effect. So this US tax credit situation caused a quite substantial sequential decline of 11%. And because it was so large, 3.6 billion, the positive development in energy generation and storage could not really make a big difference to that decline. So now we are done with the revenue discussion. Now we move on to cost. So this is average vehicle production cost decreased by 5%. That's quite significant, but is up 1% year over year. And so what's going on? It basically has to do with the mix that we already discussed. So relatively speaking, there are much fewer US sales than in most other quarters. And there's a much larger share of Shanghai-made vehicles. And we do know that the Shanghai cost structure, Shanghai-made vehicles are just much lower cost. And so what we are seeing in this quite material decrease is, I think, mostly a mix effect. A rather highly efficient Tesla having found yet even more cost savings that is not supported by the data. And for that reason, it's almost guaranteed that in the next quarter we will see a average production cost increase. But as I said in the beginning, this quarter is not about forward-looking statements. This is about historic development. Next, we look at the average production cost per kilowatt deployed. So this was actually up 3% sequentially, but still down 7% year over year to $192.90 per kilowatt. Don't shoot the messenger, but this is not very good. There are companies that they still make money, large energy storage system for a lot less. Not in the United States, but in Asia. And that number that you look at, of course, includes Tesla's Asian battery production cost and US production cost. And I think Tesla's Asian production cost will be likely quite competitive with Asian players, but blended together with the much higher US cost, it just doesn't look that great if you compare this global basis with an Asian cost basis. Just keep that in mind. And then when you look down here for the full year totals, cost came down 19% in 2025 overall volume weighted basis, just under 29% in 2024, 40% in 2023. So huge cost declines in basically battery production. Now we get to where the rubber slowly starts to hit the road. Now we get to gross profit. So gross profit was up 20% year over year, but was down 1% sequentially. And that was actually, I think, where Tesla surprised a lot of analysts. So now let's look, okay, what was actually driving that? And what's going on, you can see now clearly on this slide. So the auto business, excluding leasing, excluding credits, contributed or an increment, or what was better year-on-year basis by 485 million. That's what you see here. As I said earlier, I think a big driver of that was a outsized number of Model Y performance, because you have to keep in mind the new Model Y is available since the first quarter of 2025, but people who owned Model Y Performance, the old one, for them who wanted to buy yet again a Model Y Performance, the new Model Y only was in many markets available from Q4 2025. So to them, that was the first time they could buy the new vehicle. And in the auto industry, we see this time and time again. When companies launch new vehicles, they always enjoy in the very beginning outsized sales because it's the latest and greatest vehicles. So the Model Y Performance, even though the new refreshed Model Y has been on the market for several months, the Model Y Performance, it was effectively a brand new vehicle hitting the road. So that was one driver for the improved auto gross profit. The other driver was that Tesla recognized more deferred revenue. In the interest of time, I did not provide a chart for that analysis. I might do this, I will likely do this in my outlook, but basically Q4 was a record deferred revenue recognition for a single month, and that was likely the other quite substantial driver. And then there's kind of an accounting effect. So Tesla produced quite a lot of vehicles. Let me stop here. That gets too complicated, because I explained that point, it would in itself take 5 minutes. So let's keep it simple. So the auto business was mostly driven by Model Y Performance, FSD revenue, deferred revenue release, and likely there was a larger number of FSD outright purchases. I think it's reasonable to assume when FSD usage goes up that there should also be some pull that makes people then actually buy the software. I'm not suggesting that any of these in isolation is the silver bullet, but I think all these effects can add up. Plus, there was the overall improved mix in terms of global geographic mix. And I think this delivered this overall quite strong performance relative to Q4 2024. Next, we had a meaningful negative, an offset from lower regulatory credits. The auto leasing is also weakening, and that's because higher value, older vintages leasing contracts are running off. Then there was a positive impact from energy generation and storage, quite material. So this business is doing quite well. And then there is service and other, as we talked about, this is growing quite consistently and also added positively to gross profit. And before we move on, I would just like to explain real quick the importance of gross profit. So gross profit is, broadly speaking, what's left over once you got the product to your customer. And with that profit, you can actually run your business. You can do R&D, you can pay for admin, selling, marketing, and all these other things. This is really what is moving the business forward. All the other spend for cost of goods sold or COGS is often abbreviated. That's really to get the product to the customer. You're not really benefiting from it long term, except for amortizing the investment. But that gets a little bit complicated in terms of accounting, so I will not explain this concept here. But broadly speaking, you want to have as large as possible gross profit base, so you can afford a large operation, you can afford a lot of R&D spend. So gross profit is one way to do it. The other way to do it is to generate a super large market cap, a very valuable share price, which gives the company a very valuable currency, and move a lot of your expenses into share-based compensation. And that share-based compensation, and this is a very important point about Tesla, creates basically a permanent capital raise every quarter. Of course, shareholders are being diluted, but as long as the percent is not very large and a very large market cap, a very high share price enables a small shareholder dilution while paying a lot in share-based compensation. And that is one of the key strengths in Tesla. So its high market cap is one of its key competitive advantages, because with the high market cap, Elon can pay Tesla employees quite well and therefore can better retain key personnel while not having a significant cash effect. And that is kind of a key insight. Tesla has quite low profitability because all this share-based compensation is recognized as a spend, but it's non-cash to Tesla. And therefore, Tesla's free cash flow looks a lot better than what its profitability would suggest otherwise. But it's something we'll discuss in a moment in much more detail. Now let's look at gross profit on a quarter-over-quarter basis. Here you can see gross profit was basically flat, despite a significant reduction in revenue caused by significantly fewer vehicle sales for the drivers I just pointed out, Model Y performance, better mix, etc. And you can see that those, unfortunately, partially one-off effects largely offset the weakness in auto. Regulatory credits improved. They helped, you can see this here, up or incrementally up 125 million, and the other stuff broadly flat, except for service and other, which was also a little bit of a drag. So now let's look at some of the relative metrics. First of all, let's look at GAAP gross margin, and CFO pointed this out yesterday on the call. Tesla, for the first time in a long time, touched back to 20%, so the number was 20.1%. And you can see this in a chart is the highest gross margin in 3 years. But I hate to be the harbinger of bad news, but that will likely be short-lived. The primary reason is that some of the one-off effects that helped the Q4 significantly, those we already discussed, will largely unwind in Q1. And then in Q1, because of seasonal factors and other things, there will be a lower vehicle sales volume most likely. And that then creates a larger depreciation charge. But again, this is not about forward-looking statements. Let's focus on historicals. But what I think everybody is asking is, okay, what does the margin look like if we strip out certain items? So now we look at the famous auto gross margin, excluding leasing and excluding, of course, the regulatory credits. And that one also increased to a long-term high of 17.2%. And again, this is driven by mix effect and deferred FSD revenue releases. And the positive news is that in 2025, overall, that helped Tesla stabilize the gross margin in auto, really just on pure auto sales, plus, of course, the added benefit from FSD at 14.5%. And what does 14.5% mean? In the global automotive industry, 14.5% is unfortunately relatively low. But here again, we have these effects with Tesla's share-based compensation and other things. But broadly speaking, you want to have at least around 18% in the auto industry to have like a good, healthy business. A lot of competitors have closer to 20%. Going significantly above 21 or 22% is in the current environment very rare. And typically, once an automaker goes below 14% or 13%, they're in big trouble. But in Tesla's case, Tesla benefits from non-auto businesses, and the high market cap helps pay employees via ongoing equity raises effectively. An automaker that is worth, let's say, 50 billion and at large scale as Tesla can't possibly pay as much in share-based compensation because they would generate every quarter. Let me do the math real quick. They would generate every quarter multiple percentage points in dilution, which would be completely unacceptable. So next we look at the all-in auto gross margin here. Thanks to regulatory credits and a few other things, margin looks much better at 20.4%. Next, we look at the margin development in energy generation and storage. Here we can see that margin came down sequentially 2.8%. This is something I've long predicted would happen because I and my team, we monitor the space quite closely. Also, in part to inform our semiconductor or data center coverage. And it finally happened after the margin creeping up for several quarters. It pulled back down by, as you can see, quite meaningfully, like a 280 basis point drop quarter over quarter is quite substantial. However, even at the lower gross margin of 28.6%, this is still a very attractive gross margin for a basically commoditized hardware business. And next, we look at the margin in the service and other segment. Here you can see margin came down 1.7 percentage points sequentially, is up nicely 4.7 year over year. Margin is 8.8. 8.8 is a very low margin, but it's also, or it also means that Tesla is not really squeezing their customers. But the key takeaway for investors is that this is not going to be like a major driver of the business. So now we get to the what I would call, let's be brutally honest, points. Now we're going to talk about operating expenses. So operating expenses, and you can see this over here, comprise R&D expense, research and development, selling, general and administrative expenses, and restructuring and other charges. Tesla booked this quarter yet again restructuring charges, less than in the third quarter. In the third quarter, Elon basically eliminated temporarily the Dojo team that caused a larger restructuring charge, and he apparently did more restructuring in the fourth quarter, which are roughly half the size of the third quarter. So this number is slightly inflated by restructuring charges, as was that number. So the increase in the last 2 quarters is slightly inflated by these restructuring charges. So the real trend is not as aggressive as what it looks like here. But you can see that operating expenses have been growing quite substantially. In 2023, 22% year over year, 2024, 18% year over year, and this year, 23% year over year. But as we looked at in the beginning, revenue has been essentially flat during this entire period. So what is going on? Because effectively it means, Tesla is becoming much less efficient. And here on the next slide, you can see the net result of that profitability. So GAAP profitability is basically going into the basement, and you can see the last 2 quarters really low. Let's not even talk about the first quarter and second quarter of 2025. So overall, for the full year, profitability came in at 4.6%. That's down 2.7 percentage points from 7.2%, which was already quite low, from 9.2% in 2023, from the quite attractive 16.8% in 2022. So those were like really rough years, and basically 2025 was even worse than 2024. As a result, so revenue was trending sideways, but operating expenses went up a lot. So what is going on? What is going on is what you see in front of you. So this is R&D spend. So this is the largest position within operating expenses. It's a little bit higher than SG&A spend. And you can see that R&D spend, so research and development, is growing very aggressively. So the fourth quarter was up 40% year over year. The prior quarter, 57%. The second quarter, 48%. So Elon is really pushing hard on R&D. And here comes the hard reality. A business that is not swimming in money, like, for example, in NVIDIA or Meta or Alphabet, that is growing R&D spend so aggressively, cannot be assumed to be a dominant, confident player. It's simple as that. Just think about it. If you think like, oh, I'm years ahead in FSD, in autonomy, nobody can catch me, money is going to come in soon, I'm years ahead in humanoids, nobody can catch me, you're not going to grow so aggressively your R&D spend. So I think the hard truth is, and if you do proper research, you can tell there is not a large gap. Personally, I spend a lot of time on humanoids, and my team does so as well. I have a number of people who feed information, relevant information from research papers, company research, etc., into me. And it appears Tesla, and don't shoot the messenger, basically has no lead in humanoids. I know I will be crucified for that on X by the Tesla community, but nobody will tell you the truth, so I will. But if you look around objectively what companies put out, etc., and piece together the few comments Elon drops once in a while, I think you can see a very clear picture. Not long ago, Elon commented under a post about a Chinese humanoid, just one word, impressive. And he was not sarcastic. For example, yesterday on the call, Elon was asked about competition for Optimus. He talked about that the biggest competition for humanoid robots will be from China by far. And he talked about how incredibly good the Chinese are in scaling manufacturing. And he also talked about that they're also, quote, quite good at AI. And then he kept for several more sentences repeating China is actually quite good, blah, blah, blah. So he is clearly quite impressed what they are delivering. And if he had right now a vastly superior prototype of Optimus, I don't think he would praise China so highly. I followed Elon's for 20 years, and this is simply not how he rolls. He is not giving undeserved praise, and he is not boosting competitors that are not on par. So I would highly recommend investors take his comments just as they are, assume the Chinese competition is very good. But here's the key point for investors. There won't be any Chinese humanoids on American soil. I highly doubt that a Trump administration would allow any imports of Chinese humanoids. So the good news is the competition will be limited to makers in the Western Hemisphere. But as we have seen in other technologies, we have reached a state where it's not that the Chinese copy from people in the West, but the Chinese keep increasingly exporting their technology to the West. And I believe humanoids will be the first quite large-scale case of that type situation. It's already taking place quite significantly in the auto industry, for example, in batteries for a long time. But the strategic ramifications for the shareholder and how to position, will all be covered in my outlook. Because as always, even if you get Tesla's fundamentals 100% right, you can be 100% wrong on the share price. And that's why you need to understand the hype. And once you understand the hype, you can trade the large up and down swings. And next, we look at the other quite large cost drivers. So operating expense is not only driven by escalating R&D spend, but also by SG&A spend. So the SG&A spend, I looked at the 10K, there appears to be a significant legal item. So keep that in mind. But even if you strip out these items, there's still quite substantial growth in SG&A. But we need to look at this on a relative basis. This is what you can see here. So in the fourth quarter, Tesla, at least ever since it left the embryonic startup phase, it never spent this much on SG&A as in the most recent quarter. It spent 6.6% of revenue on SG&A. Or in other words, Tesla has never been less efficient than in that quarter. Again, in part it's driven by legal expenses, but the legal item doesn't fully explain that increase. So I assume, since it's unreasonable to assume that Tesla became administratively less efficient. So most likely what Tesla did, they tried to push sales harder, probably try to expedite sales, end of quarter push, things like that, and other things that are sales related, which if correct would tell us that the intensity of the competition is not abating. Then when we look at R&D spend on a relative basis, you can see like a similar picture. There's a significant upward trend. The only reason why a Q1 2025 had a high R&D ratio was because there was a revenue drop-off because of sales dropping due to the Model Y transition. But excluding this one-off item, Tesla never spent more on R&D than in the fourth quarter. And because the first quarter will be relatively weak because of seasonal factors, we already know that this ratio is going to grow. But again, I'm sorry, I constantly move into the forward-looking statements, even though I said we wouldn't. So what's the end result? So if you take everything together, Tesla's operating expense margin was never higher. That came in the fourth quarter at 14.5%. So, and now you know why the operating margin is so low. And the operating margin will likely stay very low, even with Cybercab rollout, etc. Because Tesla already told us they are going to significantly increase investments, etc. So what I call the Amazon scenario, so where a company basically reinvests everything they make huge investments that then translate in relatively low profitability, high operating cash flow, but high ongoing reinvestment. That basically leaves the company net with low profitability and low free cash flow. But because the overall scale of the company keeps growing, investors keep buying the stock and bidding the stock up. So I think that's going to happen with Tesla as well. The only big difference is that Tesla, of course, trades at a very, very high multiple. But we'll discuss these valuation considerations more in detail in the outlook. So next we move on from operating profit. Now we move on to non-operating items. So that comprises net interest income, net interest expense, and other expenses or income, and that item in aggregate was negative 228 million. So what happened? What happened is that there was a negative currency effect, and of course there was a roughly 300 million negative non-cash effect from the mark-to-market of Bitcoin. You can see this here more clearly. Tesla's large 44 billion cash balance creates a quite large interest income. But all of that was offset by this very large other expense line item, 592 million negative. So there's a component of non-operating income, and that item was mostly driven by Bitcoin. And you can see this here on the next slide. This item is only negative 285 if you exclude this non-cash item. But it's a non-cash item, so it's not really something anyone cares about. So next we then move on to the GAAP profit before tax. And you can see that it's rough. It keeps dropping. So 2025 was down 41% after being down 10% in 2024, after being down 27% in 2023. So basically, after 2022 was quite difficult for the business. In terms of EPS, Tesla benefited a bit from a lower tax charge because there was less profitability, there was less effective tax payment. You can see this here in the tax provision dropping to 325 million from 507 million. Tesla's effective tax rate dropped to 24%, so there was a little bit of a relief from taxes. Next, we look at a net income here, a similar story. So net income, GAAP net income was down 63%. So that is a lot more down than adjusted earnings because, and you see this in a moment, because this reflects the high share-based compensation Tesla provides to employees and executives. And so in 2025, that number for the full year was just under 3.9 billion, and that is down 46% year over year after down 21%, 28%. And when we zoom out yet again, you can see what's going on. So Tesla's GAAP net income that reflects all the spend peaked in December 2022. And Tesla's peak on a trailing 12 months basis was $12.6 billion. It managed to roughly sustain that level for 2 more quarters, and then it was basically relatively consistently downwards. And here is another kind of hard reality check. Look, I'm a great Tesla fan, but you cannot sit there with a straight face and say, oh, no, competition didn't catch up. If you look at the data, it's quite absurd to even think that in 2026. So effectively what happened, and now we don't look at the absolute numbers, but on the change, on the percent change, the growth rates, you can see here again when everything, but basically we moved from a very rapid growth phase quite quickly into a decline. So people always talk about the Twitter acquisition and the fallout, but really it was also significant underperformance by the business. And Tesla, of course, people worked very hard and they achieved great things, but in terms of valuation and what was delivered, there was just a huge gap. So in terms of just pure financials, there was objectively significant underperformance. But again, strategically, as I said before, this is not the way you can assess Tesla's investment. Otherwise, you will always make the wrong calls. As I said before, if you, for example, forecasted with 100% precision the 2025 fundamentals, you would have been 100% wrong in the stock because you would not have bought the stock at the April lows. And at this point, I need to point out, credit where credit is due. In April, I predicted in January 2025, stock would be weak till April, and then people should get into the stock. What happened? Stock sold off massively to below 200 into April and then soared from April. When the stock got later in the summer to the high 300s, 380, 370, etc., I warned people. But then Elon came in with the 1 billion TSA purchase that triggered a massive rally, and that pushed the stock into the 400s. There was nothing else going on. It was not the robotaxi rollout. And then I warned people should get out at 495. I totally nailed the peak. It's all documented. You can all look it up on X. But the bottom line is, if you invest a lot of money in TSNL, you should keep in mind, number one, the fundamentals. You need to monitor the hype. And when the stock gets clearly overheated, regardless of what you see, what's going to roll out, you need to take profit. Because if we are brutally honest, since 2022, Tesla was, and don't shoot the messenger, was an awful investment. If you just held the stock and never sold. Sure, if you bought in 2019, 18, etc., great investment, but excusing 4 years or maybe more underperformance, and you have to not only look at the returns that you or the stock basically flatlining, but also what the market did, and the market is massively up. I don't want to pontificate too much about this topic, but I think we have these discussions all the time with investors. You basically have to reset your valuation base every year. It's like you can't just say, oh, I bought McDonald's stock in the 70s. Yes, it didn't do anything. I'm making this example up. 5 years, but it did phenomenally well for 20 years. That's kind of missing the point. But anyways, let's move on. And next, just for completeness sake, non-controlling interest, not a needle mover in Tesla's case, so we move right on. Now we look at GAAP shareholders net income. So this value relates to the share price. And you can see for the full year 2025, this number came in at 3.8 billion. In the most recent quarter, shareholders net income was down 64% year over year, 39% quarter over quarter, and was down to 840 million. And that's the lowest quarterly number since the first quarter of 2025 in a very, very long time. Then there are a lot of adjustments, as you can see. So net income adjustments reached a new all-time high, 921 million. So what are they? That is number one, share-based compensation, and then there are other items. There are essentially two big items in there. One, there's over 600 new all-time high in just share-based compensation, and the other one is the unwind of the Bitcoin charge. Again, it's a non-cash charge, so you unwind it, you add it back. You do the same with the share-based compensation because you're not spending money directly. You're diluting your shareholder base, so you're adding back the spend to get to adjusted shareholders net income. And here in this chart, we break out share-based compensation. So Tesla shares, Tesla issues to employees and executives. And it's not a secret, everybody knows Tesla is very generous when it comes to compensation, share-based compensation to motivate the troops. And the fourth quarter saw a new all-time high and an unprecedented spike in compensation. You can see this here, up 49%. In my outlook, I will be discussing more in detail what's going on, but I try to wrap up this video because it's already quite long. But there are a couple of very important items left that we need to discuss before we move on. Just look at 2025. So share-based compensation alone was 2 billion, and shockingly is up 52% year over year, even though the revenue is flat. Then even after stripping out these items, the adjusted shareholders net income for 2025 is down by almost 1/3, 31%, down to 5.9 billion. And the fourth quarter was broadly flat sequentially, down 1%, but down 31% year over year. Here on this chart, you see the direct effects of the high share-based compensation. You can see up here on a quarter-over-quarter basis, basically ever since Elon's first large comp package was recognized, the dilution went down to sub 1% year over year, as you can see. But then recently, Elon or Tesla compensation committee, whatever, they significantly increased compensation, as you can see here. So now dilution is significantly larger. Next, we look at what this means in terms of adjusted EPS. Here you see the EPS numbers with 3 decimals. So you can see on a rounded basis to 2 decimals, as usually reported, EPS is flat. On a slightly more accurate basis, a slight decrease, not a needle move at all, just pointing it out. And for the full year, adjusted EPS is down 27%. Last year was also down 27%. The prior year, 2023, was down 23%. So again, since 2022, it was basically downhill in terms of earnings. Next, we look at a very, very important metric, and it is operating cash flow. Operating cash flow basically shows you how much you can invest. And in Tesla's case, it's quite a lot. So Tesla generated 14.7 billion operating cash flow in 2025. And when it comes to operating cash flow, it's usually best to look at it on a rolling basis, so not just one quarter, because as you can see in this chart, there's quite a lot of volatility. Is significantly driven by inventory changes, changes in payables, receivables, and so you want to look at more on a smooth basis. But because we're now in the fourth quarter, we can look just at the full year 2025. So the number went down only by 5%, and when you looked at all the earnings numbers that came down by a lot more, you might be surprised. But the reason, or a big part of the why it's only so little in terms of operating cash flow, is because Tesla has this very valuable currency at share price with which it can compensate people in production, manufacturing, in R&D, in SG&A, in all areas of the company. So even though Tesla's profitability is very, very low, its cash generation, because it has this valuable currency it can use, is a lot higher. And ultimately, the operating cash flow is what matters way more than accounting profits. That is the key insight. And that's why I referred to it earlier to the Amazon scenario, because when you look at Amazon, again, their profitability, earnings, and even free cash flow relative to their market value are quite abysmal. But their Amazon's operating cash flow is enormous. Next, we look at what was driving the drop in operating cash flow on a quarter-over-quarter basis. Here, the by far biggest driver was that basically the fourth quarter lacked the primary driver of the strengths in the third quarter. And the strengths in the third quarter was that Tesla sold a lot more vehicles than it produced, and that caused an inventory reduction, which caused a release of capital. And that release of capital boosted the cash flow, the operating cash flow, to 6.2 billion. But that boost, because in the fourth quarter, Tesla produced roughly as many vehicles they sold, that boost disappeared. And in a change analysis, in a bridge, what you look at right now, this disappearing of this effect is shown as a negative. And so this is what you see right here. This 2.3 billion was basically the benefit in Q3 that is not there anymore in the fourth quarter. Then also net income was a little bit lower. That was negative. There was higher depreciation, which is added back because it's a non-cash item. There's a pure cash perspective. Then there was, as we just looked at, a higher share-based compensation. So the add back is higher. So it's not the total amount. It's the incrementally larger amount that was paid in the Q4, and that's why the add back is higher. It's 291 million. Then there was a little tax benefit in terms of cash. Then there was the unwind of the Bitcoin charge. Again, Bitcoin was a negative. It lowered net income, but it's not it's a non-cash item, so you have to add it back. So that's that item. And then there was some other stuff, and then you end up in 3.8 billion. But again, you always have to zoom out a bit. You need to look at these metrics, not unidimensional. Okay, what's the total amount, but also how have key metrics changed. So next we look at a days payable outstanding. It shows you did Tesla boost operating cash flow by, for example, increased payables? And the answer is yes, they did, but not in a huge way. So payables did increase, and you can see this here. Days of payable outstanding increased to 61 days. But as you also can see on this chart, it's still in the completely normal range. And in fact, the third quarter of 2025 at 52 days was basically just an outlier at the low end. So the 61, the increase that we saw, yes, does help Tesla's operating cash flow, but it's still in a completely normal range. So there was no gaming of the cash flow in any way. Next, we look at capital expenditure. So capital expenditure, or CapEx short, is all the investments. So all the AI infrastructure, data centers, factories, properties, equipment, tooling, etc. That's all reflected in here. So all the cash Tesla spends on these things. Tesla did actually underspend in 2025. They guided for 9 billion was their final guidance, and it only came in at 8.5 billion. And given that they provide the guidance in October for around 9 billion, and then it was materially lower, suggests there was maybe a slight change in plan, or maybe something wasn't delivered on time or whatever. So there appears to be something going on that was then shifted into the current year 2026. This is a very interesting item, and one we're going to spend a lot of time on in the outlook. So next we move on to free cash flow. So free cash flow came in at 4.2 billion. So that's a substantial decrease from the last quarter, but again, the last quarter benefited from this quite significant imbalance between sales and production. That number benefited by an increase in payables. If you strip out that effect, the number would be closer to 1 billion. Tesla managed down their receivables. That also provided a little benefit. If you also normalize for that number, the number would be closer to 800 million. Next, we look at financing cash flow. So financing cash flow was positive. So Tesla did net raise or issue more capital than it repaid, and the amount was 710 million. Overall, in 2025, the net increase was just over 1.1 billion. That resulted then in Tesla reporting the all-time highest debt balance of 8.1 billion. However, overall, this is still very little debt for an automaker. And the other thing to point out is that almost all of Tesla's debt is non-recourse debt. That means if something really bad happens, Tesla shareholders are not on the hook for this debt, because the debt is secured by specific assets that are tied to that debt. So Tesla is really an absolutely rock-solid balance sheet. There's absolutely no doubt about it. And when you look at other things like a warranty reserve, this is also completely in line with industry standards. And for a company like Tesla, it makes complete sense to be rock-solid, because Tesla has such a high PE ratio. So each dollar of earning is so valuable that even the taking out debt makes absolutely no sense, because just earning interest on your cash is so much more valuable in such a situation. And then we get to the cash balance. So cash balance now increased to a new all-time high of 44.1 billion. So that's a combination of it's basically the result of positive free cash flow and the increase in debt. Because when a company takes out increases debt, whether they issue a bond or through other means, bank loan, that money then goes into the cash balance of the company. So that's why when you look at available cash balance, you always want to assess the debt level. So now we are at the end of this presentation. And in this presentation, we talked a lot about the historical development, performance, various key metrics. And then in the outlook, we'll be basically discussing about Tesla's future. We will talk about what management said means actually in numbers. And as always, we will put this into context. We will do a valuation analysis, and we will assess what this means also in terms of sentiment for the stock. So if you're not already a subscriber, I highly recommend you subscribe to our investment research. It's extremely unlikely that you will regret the decision, because hardly anyone ever leaves, or we have hardly any cancellations. So thank you very much for listening. See you next one. Bye.